morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some of those Canadian-owned publicly listed banking stocks on the Trinidad and Tobago Stock Exchange. Of course, we're talking about Scotia as well as First Caribbean International, now rebranded, of course, the CIBC Caribbean, still trading under the symbol FCI. Now, both groups would have reported reasonably good earnings for investors. Let's take a look at what would have taken place for their respective 9-month fiscal quarters ended July and what investors might expect in the coming months ahead. Turning firstly to FCI or CIBC First Caribbean, let's just call them CIBC Caribbean. The group would have reported an earnings per share figure of 90 cents per share for that 9-month period ended July 2024, compared to a similar 90 cents TT dollar equivalent reported in that prior comparable period of the fiscal 9 months 2023. Now, total revenues were up just about 1.1% from 3.7 billion to 3.74 billion TT dollar equivalent. Operating expenses up 4.3% from 2.09 billion to just about 2.18 billion. Overall, that net income attributable to equity holders up just around 0.1%, so relatively constant at around that 1.42 billion TT dollar equivalent mark. Now, when we take a look at what would have contributed to revenue, well, fairly consistent when compared to the prior comparable period. Of course, net interest income eking out roughly a 1% gain in that purple column from 2.65 to 2.683 billion TT equivalent, while total operating income also eked out a minor gain from 1.05 odd to 1.06 odd billion TT equivalent, attributing to that 1% gain as we would see in the chart. Now, FCI would have come out and said that with the interest rate or US dollar interest rate cycle having peaked, and the Federal Reserve, in fact, even moving or starting to cut rates and lowering benchmark rates, that their revenues could moderate in subsequent periods, of course. And what would that mean for investors? Well, we'll take a look at that very shortly. In terms of segment performance, not too much in terms of changes here. Corporate and investment banking, the largest segment contributor, or PBT segment contributor, relatively constant at around that 1.25 odd billion in that green column, 66 odd % gain in retail business and international banking from 91 to 151 million, and a roughly 22 odd % decline in that wealth management segment for profit before tax, moving from 67 million TT equivalent to just about 52 million TT equivalent. Now, we mentioned that revenues could come under some moderation for FCI in subsequent periods as US dollar interest rates moderate or abate, and we can see that over the past couple comparable fiscal periods, there was a sharp increase in trailing 12-month earnings in that pink segment, particularly in that 9-month period of 2022, when trailing 12-month earnings moved from 66 TT cents equivalent per share to its current $1.12 on a trailing 12-month basis. Of course, dividends, however, would have been relatively constant at around that 32 to 33 cent TT dollar equivalent over the past few comparable periods. What that has meant is that with relatively stable dividends, the dividend payout ratio, of course, which is the total dividends paid over the last 12 months divided by trailing earnings per share, would have actually declined in terms of that ratio, falling from around 40% in that 9-month period of fiscal 2022 to around that 30% level in fiscal 2023 and 2024, those comparable 9-month periods. So as earnings abate, we do expect there to be relative stability in terms of the dividend paid by FCI, notwithstanding those earnings decreases that could come, or earnings moderations, and of course that payout ratio may be expected to go up in tandem with those declining earnings. So at a price of $6.81, FCI is trading at that dividend yield of 4.9%, in line with the banking sector, and a price to earnings ratio of 6 times, which is well below the banking sector average of 10.5 times. And just keep in mind, should earnings continue to moderate with those lowering US dollar interest rates, we do expect some reversion to that industry sector average of that 10.5 times, not necessarily to exactly that 10.5 times, but certainly higher than the 6 times that FCI is currently trading at. So with those stable and moderating revenues in mind, those are relatively attractive valuations at this current point. And of course, the fact that this TT dollar investment pays a US dollar dividend, Bourse maintains an overweight rating on FCI for the time being. Turning very quickly to Scotiabank, for their 9-month period, the group would have reported an earnings per share figure of $2.77 per share, 3.9% increase from the $2.66 reported in the prior comparable period. Driving this improvement was a 3.5% increase in total revenue, moving from $1.39 billion to just about $1.45 billion. Ultimately, profit after taxes up around that 4% figure from $470 odd million to $488 million TT dollar equivalent, of course. Now, SBTT or Scotia would have recorded a modest revenue growth, which was an impressive turnaround from the 2.7% revenue decline recorded in that prior comparable period. Driving this overall revenue growth rather was a 5% odd increase in net interest income, moving from just about 1.00 or 1.01 billion to just around $1.06 billion, with relative stability in its other income segment at around $388 million as well. Now, from a valuation perspective, Scotia is trading at the more expensive end of the banking sector currently. In fact, it is the most expensive banking stock on a price-to-earnings basis when compared to the sector average of 10.5 times, and of course its other peers. However, at that traded price of $57, the group does offer, or the stock does offer investors a reasonably juicy dividend yield of 5% at current market prices and with their current dividend payments. So with those increased revenues in mind, attractive dividends, but keeping an eye on those elevated valuations at the current price, was maintaining a market weight rating on Scotia for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. And of course, you can check out all our research absolutely free on our website at bourseinvestment.com. And of course, you can catch this article as well in today's business section of the Guardian newspaper, Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.